out last month. His fund returned a whopping 25%. It's a warm welcome to Michael Frazis, head of Frazis Capital Markets, and joins us now in studio here at Barangaroo. Great to have your company on the program, Michael. I guess let's kick it off with your thoughts on Afterpay, given you're quite bullish on Afterpay. Look, it's had a lot of success, and I guess in the past few weeks, a big new investor, of course, coming on board, which shot the share price up even higher. Do you think it has further to run here?
I think it really does, because Afterpay's always had that magic, so customers really love it. So it's that decision point, on a website, when you go and click, when you choose to buy something, and then you click either PayPal, or you put in your credit card details, or you go for Afterpay. That decision point then directs, a lot of money to one of those providers. And for whatever reason, Afterpay has always been able to win at that decision-making point. They're really just getting started, so their customer growth has barely started slowing down. And I think the 10-cent deal, there's probably two ways of looking at it. You could think that maybe it's a way for them to get into Hong Kong or even China, but another way is it's 10 cents' way of getting exposure to an extremely fast-growing payments company and really attack the West and go for the payments market there. So it's definitely still early days for them, irrespective of where the stock is.
I guess when you look at the pandemic we're in and the recessionary conditions globally, is this a concern for a company like Afterpay, whose customers may be suffering from job losses, because we've seen huge job losses around the globe? Where is the concern there, and how are you factoring that into your investment thesis?
Well, I think it's hard. I've always had the opinion that Afterpay was a good credit business, because if you think about what makes a good credit business, it's very short-term loans and very small amounts. Compare that to, say, a credit card business where you can rack up tens of thousands of dollars of debt, and really that debt just accumulates and accelerates. This is very different to that. It's very small amounts, and they have adjusted their credit risk. So in Australia, they'll take 25% now upfront. They'll take another 25% 2 weeks later. So they very rapidly de-risk their credit profile. And if you think about what that does for consumers, it's a very friendly form of lending in the sense that as long as you keep paying and using it, they'll continue to let you use the system. They won't insist on income. They won't insist on arbitrary tests of wealth. So it really gives access to credit to people who might not have it otherwise.
All right, so more broadly, I want to get your view, because I know you've put out an investment paper, and I'm looking at some of the comments you've made, and one is about the biggest risk for markets. This is key at the moment because we've got a couple of things going on. Obviously, the pandemic, which is the big one, the potential for second waves. You've got trade wars now rearing its ugly head again. You've got US, what's happening over there. What's your take, I guess, when it comes to risk here at home?
In terms of risk at home in Australia, well, I think we saw last night there was a huge rally based on a vaccine. There's a good chance that actually continues. Moderna has been a company that I've owned for a while. They have a very good scientific platform and a number of vaccines in the clinic. And the science was always sound, but they've never proven one could work. And this actually is a good proof of concept. So they tested 45 people, and they didn't actually expose them to the virus, so nobody really knows if it actually works. But these people did kind of have an antibody response in line with people who had actually had the virus and recovered. So it's important to know that the whole vaccine development timeframe has been massively shortened. So they already are going into phase 3, and they've already started manufacturing doses, which usually never happens. Usually you prove it works, and then sometime after that, you then set up manufacturing. This whole process has been compressed into a matter of months. So if many people think the biggest risk is the virus, but you can sort of see a way out from that. And I think that that's been reflected in the markets in the last 24 hours. So,
obviously keeping in mind that you do own the stock, do you think this has been the most positive trial we've seen so far, more than what we've seen from, say, a Gilead or some of the other kind of biotechs out there with vaccines?
Yeah, it's a hard one. It's very hard. It's going to be very hard for anybody to make a lot of money out of this. It just doesn't feel right. It just doesn't sit right with all the people that will get it. Billions of people might need to be vaccinated. It'd be very hard for a company to really make a lot of money, and maybe that's the right thing, right? Just putting that aside, what Moderna will benefit from the fact that they're getting a lot of funding to manufacture this. And because all their vaccines are made in the same way, they will get long-lasting benefits from developing this vaccine. But in many ways, they're way ahead in the vaccine race.
It certainly is a good point you make there, though, in terms of, yes, we all want to see a vaccine. It's certainly going to be a positive for the human race for a vaccine, but perhaps not. Well, we'll see how the company plays out and how it plays out for businesses. But yeah, you don't want to be, profiteering off of something that actually needs to help the entire globe at the moment. But let's move on from that for the moment, because I want to talk some of the themes you're watching, because some of your investments are focused obviously on what's thriving in this current environment. But I guess the question is what's expected to thrive in the recovery process as well, because we are seeing structural change that could be happening obviously long term post the virus. What are some of the key themes you're investing in then? And I know you've got e-commerce in there, you've got work from home, that thematic, but what sort of stocks are you looking at in light of this?
Yeah, I mean, e-commerce is an interesting one. I think there's kind of two sides to that. Like, I'm investing in companies that are thriving in the current environment. There's you can divide those into two. There's the companies that are thriving, and that's just part of the acceleration of a long-term trend. And there's companies that might sell a mask, or not that I own any of those, or sell home gym equipment that you'd probably expect not to do so well in the recovery. So if you think about e-commerce, I mean, that is the future. Digital health, that is the future. There's no doubt that these things make a lot more sense. They're a lot more better for consumers. They're a lot more cost effective. They're a lot more convenient. I think those trends will continue. And in many ways, it's just accelerated and permanent. So I'll be positioning the portfolio to benefit from the companies that have accelerated, but will also have long-lasting benefits from this period. In terms of companies, there's market leaders all around the world. You could look at Mercado Libre in South America, C in Southeast Asia, Pinduoduo, which took 10% market share out of Alibaba in a matter of years. You can really form a quite diversified portfolio of very fast-growing companies that are accelerating this current environment and are really only in the beginning of their growth phase.
In terms of where you're concentrated, because obviously you are very global in terms of where you invest, is there any geographic sort of concentration when it comes to your portfolio? Or are you really diversified across globally?
Yeah, I mean, I'm focused entirely on technology and the life sciences, and there's no doubt that the vast majority of the innovation there happens in the United States. There's good reasons for that. There's like an amazing university system. There's an enormous market. The biggest concentration is in the United States. I do think it's probably something that Australians are underinvested in to some degree.
When you look at technology in the United States, do you think the rallies we've seen there have been warranted?
Look, they are, but there's no doubt there's pockets of the market that are red hot, and I think they're probably pockets of danger right now. My fund and my investors, we've been beneficiaries of this. For example, a company like Shopify, which you've owned for a while, and you kind of were buying on the dips. That's up at over 40 times sales. Like that is punchy, and there's a very high degree of conviction that they will achieve their long-term goals, and be the go-to place for the entire direct-to-consumer movement. But at 40 times sales, that's the next few years are all baked in. You can look at companies like Zoom. Again, if you had to pick like the best technology companies, it would probably be up there in terms of its metrics. But do you really want to be paying those exceptional sales multiples? I don't think so. The good news is technology is really broad, and there's plenty of companies that are growing very fast that are very much under the radar. We're trying to focus on those and avoid those hotter sectors.